Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable. We talk about current market conditions, any questions you might have about subscription, and what to expect short-term and long-term. For those of you who are new, welcome. This is my brief bio. I was Executive Vice President and Head of Technology at Options Express. My background is technology, building software for financial trading companies here in Chicago. After Options Express went public, I decided to manage my own money and build Tradespoon. So it's been 10 years. I'm pretty excited about that. So I wanted to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally, managing and trading my own money. I've been doing it for over 15 years, mentoring and teaching subscribers how to trade stock and options. And finally, I have a master's degree in computer science. Disclosures are very important. If you're new to trading stock and options, I encourage you to pause the screen, click the pause button and go to webinar and visit optionsclearing.com so you understand the risk associated with trading stock and options, and also read the remaining of the disclosures, which are very important. I'm going to go through specific trade examples, so it's important to review this. In terms of trading plan, before we jump into a trading plan, let's talk about current market condition. Right? A lot has happened in the past 2 weeks in terms of financial regional banks, some of the global banks, Credit Suisse, today's Deutsche Bank, where all the assets on the balance sheet have to be basically repriced to reflect the new high interest rate environment, and you have run on deposits and Silicon Valley Bank and Signature Bank. So main question is contagion, right? Is this just just a couple weeks and financial system is healthy and it will go away, or is there more distress in the system, right? So the main chart is the 2-year yield, right? And you can turn on the news, and anywhere it talks about this concept of disconnect, right? Dissonance between what the Fed is saying, right? Fed raised interest rates by 25 basis points. Inflation is still higher than they would like to see. So continue to raise interest rates. Target rate is at this point is close to 5%, but the 2-year yield is at 3.5%, was 3.5% this week. So this disconnect, and I like that explanation I heard on TV. This disconnect cannot last very long, right? I mean, maybe a couple weeks, maybe a couple months, but at some point something has to give. Either the Fed will recognize that there are issues in the banking system, and even though inflation is still elevated, they need to start lowering rates, right? To maybe 4% or closer to where the 2-year yield, or vice versa, right? The bond market will realize that there are no issues in the system, or they're well contained, and we have a healthy financial system, and then the 2-year yield goes back to 5%, right? So there, right now, this is one of the main issues, right? Who's right? Is it the bond market is right, and credit default, and the issue is credit default swaps, right? The cost of insuring against the default for banks, or cost of loans, has moved significantly higher, right? So that will impact the earnings of regional banks and global banks, and will create a tighter lending conditions, right? The credit availability will significantly decrease. So that's $1,000,000 question. I posed a question yesterday. I like to do these surveys so we're all on the same page. I mean, there are basically 2 schools of thoughts, right? The one school of thought that we were in the bear market that kind of ended in October, or reached its peak in October. Inflation is going down, unemployment still remains low, China is reopening, everybody's traveling. We've seen services PMI today. People are still high, people are spending services market is good, and this is just the bull market has resumed, right? So not in the same line, but something like this, right? Something along those lines. So scenario number one, we're in bull market, right? The bull market has resumed, right? Some of the asset classes are up more than 20% from the bottom, right? Some of the technology, Nvidia, Microsoft, Coinbase, and Arc Innovation, Tesla, they're more, up more than 20%. So by definition, we are in the bull market since October. Right, so scenario number one, bull market. It's been 6 months since we've seen the lows, right? So that means, a lot of people think these are the lows, right? Scenario number two, the issues that we have seen in the past 2 weeks. This is just the beginning of the credit issues, and maybe we're not going to have 2008, right? Hopefully we're not, but most people think we're not going to have 2008. But this is not this is not the end, right? Now we have issues with Deutsche Bank in Germany, and tomorrow it'll be Greece or Spain or something along those lines. And then the scenario number two, we're kind of slowly grinding lower, and this is not the low, right? So why is this important? I personally think that it's very hard to trade, or at least invest, like longer term, unless you have an opinion on the market, right? And so the one scenario, you're a bull, you think we're in a bull market, and the second scenario, this was just a kind of a little break, 6 months break from the bear market, and now bear market has resumed, right? Which by definition will be down more than 20% from the recent highs. So that's a question. A lot of people say, listen, you have to be nimble, you have to be flexible, data dependent. You could be a bear today and bull tomorrow. I think for me personally, it's very hard to trade, right? If I have to change my opinion every week or even every month, right, or even every quarter, right? Then especially longer term trades where you hold them for months or a couple months, very difficult, right? Because usually you have a view and you just trade based on the view with the realization that the market doesn't move one way, but is this a pattern of lower highs, lower lows, or is this the pattern of higher highs, higher lows, right? That's the difference. So that's the $1 million question, right? So that's what everybody's debating, right? I do agree you have to be flexible and data dependent. And I mean, if you're a bull 2 weeks ago, you probably want to think about it, whether you want to remain the bull or how bullish do you want to be. When the market broke, when we broke through December highs, right, I had to scratch my head and decide, do I want to be a bear, right? Like, why is all of a sudden we have 6 months break from the bear market? So you need to get back to the whiteboard. You need to be flexible, but nonetheless, your opinion is important and the view on the market is important, at least, going to the end of this year. So let's go through the room and just say, you think, are we in the bull market and bull market has resumed, or are we in the bear market and the bear market just took a little break, 6 months break? Jim will talk about puts. I'm a top-bottom approach, right? So I don't look at the balance sheets. I don't sit on earnings calls and write opinion, right? I'm not a financial analyst, but I do have a top-to-bottom approach, and my view is that 99% of the stocks fit that view. Sometimes they outperform, sometimes they underperform, like Tesla, right? It's underperformed the past 12 months. It's outperformed the last 6 months, right? So, you'll have these divergences, but the path of least resistance and path of patterns are very similar, and we'll talk about that. So first, good for both. Okay, Jim, so we'll go over. So bull, okay, so we have one bull, bear. Okay, bull, bear, we are in the bear, 2, okay? So few 2s, 1, 3s, I don't know, right? I haven't been trading long enough, or I don't care which market we're in, as long as I can watch the tape and, don't fight the Fed. Bull for oil, Michael, 2. All right, so mostly 2s, couple 1s. Well, if you've seen my, webinars in the past, since January of 2022, I have been bear, and it's been a long time. Usually, for the average recession or average bear market does last about 14, 16 months. This is probably going to be longer, right? Probably going to be longer. So I remain in the bear camp. Always said, simple reason, just finance 101. When you have rapid rise in interest rates, probably one of the fastest rise in interest rates in the past 100 years, or one of the fastest rise. Ultimately, financial system is going to be in distress, and at some point, you will have issues in financial market and lack of liquidity. So 2 weeks ago, this was just a kind of a textbook opinion without a lot of evidence, right? Because and we've seen this rally kind of confirming that inflation is low, people are traveling, China is reopening, everybody's buying cars, they're buying Gucci bags, and and life is good, right? So, but 2 weeks ago, now we have concrete evidence, right? And it's hard to imagine that it stops at Credit Suisse and First Republic Group, and there are I don't know what they say, 400 banks in the United States. I don't know, globally probably thousands of banks. Just can imagine that Silver Valley Bank was the worst bank, right? I understand, they had very different business nature of business. They didn't have a lot of retail depositors. Mostly it was Silicon Valley, startup community. I understand it's different, but what about corporate real estate, right? What's going to happen with all these real estate and all the private equity that invested in real estate if liquidity is going to continue to be tight, and now it's even tighter, right? Because before it was just raising interest rates. Now, not only raising interest rates and keep them elevated, well, now banks have to pay a lot more money. Basically, banks are not encouraged to lend, right? And that's it kind of resembles 2008 issues, right? Different issues. We don't have, mortgage-backed securities that worth nothing. I mean, underlying assets seems to still be healthy, but nonetheless, banks gonna lend less, right? And that means that to refinance your loan, if you have 40-story building all over the United States, it's going to be hard for you to refinance that debt as it matures. So for that reason, I think we are trading in the bear market, and this bull, right? We had a pretty strong sell-off, right? I would say, I do like Elliott Wave, so strong A, big drop, right? Multi-months drop. Then we have multi-months rally, right? To retrace, probably, usually it's a half of the losses, right? So we retrace half of the losses, and now we are in the beginning of wave C, right? Wave C. It could be the same as A, right? It could be a little bit less, it could be a little bit more. That will depend on the events, right? But I think we are trading in wave C, right? And this was inflation, right? Hyperinflation, right? Inflation went up. This is inflation went down, right? The reason, and now we're trading in recession, right? Probability of recession going, either entering some kind of recession or, right? So now completely different theme and correlations, right? You can see that, when QQQ is down, right, Treasury is up. In wave A and wave B, it was the opposite, right? Treasury's interest rate, bond market is down, QQQ is down. They moved in the same direction. Now they don't, right? And the same thing is in gold, right? So when market is down, people sell small caps and banks, and they're buying, silver and gold. So that's the new theme. Any questions? Uninverted yield curve will restore bull market. Yes. So one of the observation, yield, right? 2-year yield pays as much as 30-year yield, right? We used to have even, here it was 200 basis points, 100 basis points difference between 2-year yield and 10-year yield, and now it's only 30, right? So yield curve was, like this, right? This is yield versus time, right? Versus, maturity, right? Time maturity. Right, and now the curve has shifted, right, to something where it's like more like this, right, flatter. So this is signs of recession, right? This is also sign of recession. Bull market, it has to be like this, right? I mean, and that's the bull argument, right? If the 30-year yield continue to go higher and the 2-year continue to go lower, and at some point yield curve looks like this, that's the idea of a soft landing, right? Idea of a soft landing. If it happens, that's great, right? If it happens. If it doesn't happen, then or it stays flat, right, or it goes back to this, that's not good for the market. All right, thank you, Doug. Anyone else? Okay, so meanwhile, in terms of support and resistance, I encourage you to look at Stock Forecast Toolbox, right? I think this is a really good model, basically saying, we're actually model turned positive. It was neutral, now turning positive, basically saying, 390, this is it, right? 390, this is it. And we might retest 410, right? As we are approaching next earnings season, right? We've had 2 weeks in a row where we're trading, we made new highs. We'll see where we're going to close today, but 390, 380 are important supports, right? Obviously, as long as the 2-year yield moves 5%, right? We were down as much as 6% this morning, right? When the credit default swaps on Deutsche Bank has kind of increased exponentially, but market has been resilient, right? Deutsche Bank is on the verge of bankruptcy, one of the largest banks, and QQQ is down only 0.5%. So you have to give it to bulls. They're very resilient, right? One explanation is seasonality, right? It's just a good time of the year, and spring is in the air. We're still optimistic that the earnings season that starts, in a couple of weeks is going to be positive, right? So that's the soft landing state, soft landing camp, very resilient. And model basically shows that, assuming the Deutsche Bank is not going to default, right? If they're going to default over the weekend, then obviously model is going to be wrong. But assuming you don't have new banks defaulting over the weekend, the path of least resistance is to potentially continue going higher, right? This point, I don't think we're going to break the downtrend, right? We've attempted it this week, got very close. We might get next week close again. I mean, I guess potentially we can get year-to-date high. We can retest this, right? But I still think it's going to be kind of a triple or quadruple top. Right, it could be a little bit lower, could be a little bit high. I think it's going to be a little bit lower, right? Because the earnings is, everybody's going to shift their focus into the earnings, which basically next week I'm out. So there's 2 to 3 weeks left, 3 weeks left till the next earnings cycle. Not a lot of time to make a lot of damage. So short-term 390 is your support, right? If you're day trading. And overhead resistance at this point is last few weeks low, right, which is around, I don't know, 402, 407. So that's your resistance number 1, right? And this is 390 is your support number 1 for day trading. Bigger support is last week low, 380, right? It's very important for the bulls to hold on to last week low, which also corresponds to the December low, right? This is the last support. The next support is, 52-week low, and I don't think it's going to hold, right? I mean, we might get a couple bounces, but at this point, if this level doesn't hold, which is not that far, 375, 380, then it immediately opens up the doors for 350, which may or may not hold, and most likely will not hold. So you could be a bull or you could be a bear. That's fine. I would watch the support, right? And then it's all about risk management, right? Risk management. Whether you bull or bear, you could be bullish, right? Some of the positions could be bullish, some of the position could be bearish. I would watch 380 level, right? I mean, 375 is December lows, something along those lines. But this is your support, right? This is your support where you do not want to see market drop below this level. And same thing with 2-year yield, right? As long as the 2-year yield is below 4%, right? Kind of the magic line in the sand. As long as we're below 4%, at any given point, we might retest this level, right? It could happen by end of today. It could happen sometime in next week, but the treasury market has to get more stable because treasury market is more volatile than the equity market, right? That's a problem. That's a problem. So that's a possibility, but I still think high chance we get to 400, 410, and then as next earnings season unfolds, right? Earnings season is going to be either better than expected, where you don't see issues, right, with the current credit environment, and then the market stays kind of sideways going into the summer. But when banks announce earnings in April, right, April 15, it will be very important to see what the forward-looking statement, right? On one hand, JP Morgan can say, listen, our deposits has billions of dollars has been transferred to JP Morgan from all the regional banks, right? And that could create a rally in the bank stocks. Or they can say, listen, despite increase in deposits, the cost of insurance, cost of lending is going to significantly, decrease our revenue going forward, and then the banks will sell off, right? So the news in April and the reaction to this news will actually determine, when are we going to retest 52-week low, right? Is this going to be April, May, right? Or is this going to be May, June, July, right? Something like that. That is not known. We're not going to know this until the earnings season, assuming there's no other, black swan events. Okay. Any questions in terms of what to expect? So size, right? Risk management. So let's say you're bullish, right? You basically say, listen, all these banks are falling apart, and we're still at 390. This bull market continues on, no problem. Okay, a little issues in banks, not a big deal. We still have oil, right? A lot of people say we're bullish on oil, we're bullish on industrials, right? The stimulus package. Okay, so if you're bullish, let's say you're buying, you say 390, I agree with the model, 390 will hold, we can get to 410, 20 points. I mean, it's 5% rally. Okay, I'm in, right? Where's the stop loss, right? So before you get into a trade, I encourage everybody to keep a journal and have a checklist, right? Before you enter a trade, you have a checklist. How much cash do I have? How many positions do I have? What my position size is? And other, some people don't like to trade illiquid options. Some people don't like to trade stocks under $5. Whatever the checklist, right? We all have a little slightly different checklist, but we all share the same thing: cash, number of position size. If you don't think about how much cash do you have, if you don't think how many positions you have or the position size, at some point you will be on the wrong side of the trade, especially in the bear market, and you're going to have very large losses, right? You want to avoid that. So risk management is important. So let's say I'm buying at 390 because the model turned bullish and it shows an uptrend. What is my stop loss? Again, I encourage this line in the sand. I would probably not hold a position if market reaches, let's say, 374, 375, right? Breaks through that level. Okay, so I'm buying at 391, 375, I'm risking 15 points, right? That's my stop loss. I go in my journal before I end the trade, I said, okay, I'm willing to risk 15 points, right? On the $10,000 account, I propose not to risk more than 2.5% per position and use dollar cost average or option laddering. The idea to break your trade into multiple increments, right? So 1.25%, 1% per trade. So that would be $250, right? Then right away I'm thinking $250. If I'm risking 15 points, that means I can do 15 shares, right? 15 times 15, that should be less than 250. 15 shares, right? So that's the thought process. Risk management. It doesn't seem like very difficult, right? You don't have to have years of training and technical analysis. You can look at this weekly chart where each candlestick is 1 week and basically say, listen, if the market breaks last week low, or if it breaks December low, something is wrong, right? I don't know what it is, but something is wrong, right? So I don't want to kind of wait and find out why, so that's my stop loss, right? And you have to be disciplined. You would write that down. On the upside, you basically say, okay, maybe 420, right? If you're bullish and you're in soft landing, okay, wait till we break 420 before getting overly bullish. So at 420, 410, you want to get out of the trade, right? So maybe 15 points to the upside, maybe 15, 20 points to the downside, right? That's your trade, right? You risk $250 to make $250. And as long as you're buying at the support, right, and the distance between to support is a lot less than to resistance, it's a good trade, right? If you're bullish, this is a good trade because you're making an assumption that 380 will hold. So writing down number of positions, position size is extremely important. And I propose not to have more than 4 positions like that, right? Someone asked Tesla. Tesla is probably not going to outperform QQQ, or it's going to outperform technology, right? So if the spider is going to go up 5%, I mean, Tesla usually moves, let's say, 1 to 4, right? So if the market is going to go up 5%, Tesla might go up 20%, right, to 240, right, to 20. So same thing, you can say, listen, I think Tesla is going to do this, right? It's going to retest this downtrend, right? As we approach an earnings season, and we're getting some visibility to how many sales we have from Tesla in China, right? Same thing, right? You would basically say, well, December lows, right? Same setup. December lows or last week lows is a line in the sand, right? If we drop below 160, something is wrong, and we're probably going to get to 100 sooner than later, all right? So, okay, you're buying at 190, you getting out at 155, right? So you have roughly 30 points to the downside. To the upside, you might say, okay, 220 to 40, same thing, plus 30 points. So on spiders, you were doing 10 points, right? Or 15 points. This is what we said. Yeah, 15 points. On Tesla, we're doing 30 points. So 2 to 1, 2 to 1. All it means is that on the $250, you can't really trade. If you traded 15 shares for spiders, right? If you traded 15 shares on spiders, well, you can't really trade 15 shares on spiders because you can see the stop loss is wider. Okay, so you trade 7 shares, right? Same setup, you do 7 shares. Because if Tesla drops 30 points, you don't want to be down more than $250 on $10,000 portfolio. So the trend are very similar, right? You look at the Tesla chart and you look at QQQ chart, or you look at the spiders charts, I don't see much difference, right? Especially with these mega cap stocks. So if you're buying spiders, QQQ and Tesla, just think, or if you're buying Tesla, let's say Microsoft and JP Morgan, just keep in mind, you're not diversified. You're really not diversified, right? Maybe if you buy First Solar, I think Bob yesterday said, Vlad, what about First Solar? Yes, First Solar is an exception, right? I didn't look at the statements. I don't know what drives this rally, but we've seen meme stock. I'm not implying that First Solar is a meme stock, but something drives this, green energy and semiconductors, right? Okay, great. And you could compare it to semis, right? Since October, also impressive rally, right? So you can't really say that, okay, First Solar is that much different from semiconductors, right? 57% up after 50% down, right? So 50% down, 50% up, retrace half of its losses. First Solar never dropped that much, right? From 2022, let's see, it dropped 50%, so similar to semiconductors, 50%, but obviously it rallied 260%. So something is different about First Solar. First Solar is an exception, so that's bottom-up approach. But Tesla, it's top to bottom, right? If you think Tesla is going to outperform the market, and it will be like First Solar, probably not. So hopefully I answered a question on Jim on Tesla. Minsky moment, Joseph, I don't know what Minsky moment is. Are you referring to Russia-Ukraine war or something else? What's Minsky moment? Are you just making fun of my accent? Minsky moment. Oh, there is such a thing. To the end stage, okay, very good, sorry. The term refers to the end stage of prolonged period of economic prosperity that has encouraged investors to access risks at the point where leading exceeds the bar. At that point, Minsky wrote, increase in speculative Ponzi scheme. Yes. Sorry, I learned something new. Thank you for sharing. Yes, so we do have a Minsky moment. We do have a Minsky moment. Who was Minsky? Hyman Minsky. No, from Chicago. Very nice. Macro post-Keynesian economics. Okay. Yes. So the idea, right? So we do have Minsky moment because 2-year yield is probably not going to drop to 0.5 or quarter percentage or negative, right? The year, we've had since 2000, I don't know, since February 20, right? Or even, right, we're not going back to 2008. We're not going back to 0.5% for 2 years, which we enjoyed in the past 15 years, right? Rates will drop, right? It looks like it will drop. It looks like it's already started dropping, but it'll probably drop to maybe 3%, maybe 2%, right? Depends on how severe the recession is, but it's not dropping to zero, right? It's probably, it'll probably give up half of its gains. So 2.5, 2 to 2.5. So, okay, that's a lot, that's a lot less, it's a much tighter conditions when, Fed print in the balance sheet, Fed's balance sheet to continue to increase, right? It decreased the past 14 months. In the past 2 weeks, most of it is back, and this is probably beginning. So Fed's balance sheet is going to continue to increase. So rates will probably we're not going to see these rates, maybe even in our lifetime, right? Maybe in our lifetime. Thank you, Joseph. All right. Any questions? Meanwhile, market is resilient, right? QQQ is turning almost flat, right? Spiders, if you look at the futures, right? If you look at the futures, they were actually down, right? They did break through the lows and now staying above, so that's good. What else is interesting? Crude oil is retesting 52-week low, right? Pretty weak. You can see there's a lot of damage being done in one thing that everybody's watching is Russell 2000, right? Russell 2000 actually broke through December lows, and not that far from October lows, right? So a lot of concern, again, tighter lending conditions, small caps, that's a problem, right? They were leading the market on the downside, they were leading the market on the upside, and now they're leading the market to the downside. I mean, it's a pretty strong support because it's, again, pre-pandemic support level. So it's probably going to hold, at least short term, but nonetheless shows you how much damage has been done in the market. So I would watch small cap, see, as long as we're trading below December lows, then most likely, we have at least a retest, not from a distant future. It's not that far, 3-4%, but that's the risk. Same thing goes with KRE, right? KRE. KRE is sitting at the key support, right? It made new lows this week again, which is problematic, right? That means it can continue going lower. That would push the market down again. and then banks, right? Those are the weakest link, right? And banks are sitting at September-October low, right? 52-week low, and they are below the pre-pandemic low. So, you know, if banks cannot hold on to this level, then the next level is probably around 26, 27. So that's what I would be watching. All right, how do we, okay, this is all nice and wonderful. What do we trade? How do we trade? Well, you know, first of all, it's all about risk management. First, I would think before you decide which signal to take or what new position, always keep a journal, always have a checklist before you enter the trade. And that checklist, you know, if you're bullish, I propose to have 30% of your portfolio in cash. If you think we're trading in the bull market, 30% in cash. If you think we're trading in the bear market, I propose 50% of your portfolio in cash. What do you do with the rest of the cash? Very common question right now. One of the bubbles, you know, if you follow the, you know, social media, one of the bubbles is money market fund. It's just out of control, right? Everybody's putting money in money market fund. It's at all-time high, exponentially growing, right? Because everybody, you know, you don't need to take a risk and just make 5%. I mean, there could be dislocation in money market funds, but it, you know, I mean, if banks are bailing out, if government's bailing out banks, they will bail out money market fund. Well, it's a government, right? Money market funds are guaranteed by government. So I'm not worried about money market fund, but you could have dislocation where it might not trade at parity, right? There have been historical occurrences of that. But nonetheless, I still keep majority of my money in bond market or money market fund. So you keep half of your portfolio in money market fund, and you just double check with your broker dealer, make sure you do get, I don't know, 4.5, 4.7% on your money market. Second one is, again, portfolio drawdown. Portfolio drawdown, what does it mean to me? 4 positions and not risking more than 2.5%. Every time I put on a trade, I go through my checklist and I go through all my positions, say, okay, do I have 4 positions? If I have 3, okay, I can put on another position. You know, is my position down more than 2.5%? If it is, then I exit out this position. So that rule is important because you want to make sure you are not down more than 10% of your portfolio. That is the, right now, you know, the common theme is if you don't think about risk, if the risk management is second, right? If your returns are #1 priority and your risk management is #2 priority, this is not the market where you think like that, right? Maybe in the bull market you can think like that, but in the bear market you cannot. You have to think about risk before you look at the returns, right? So I encourage everybody to keep a journal, and before you enter the trade, just look at number of position size. I mean, it's easier said than done. You know, usually we learn on our own mistakes, not on other people. But I know if in my case, you know, every time I had these, you know, trade on emotions, right, where my blood pressure goes up, there's only 2 reasons, right? It's either I have too many positions or position size is inappropriate and the trade is going against me. And we know trades do go against you, right? You could be on the wrong side. You could be a bull and we're trading in the bear market, or you could be a bear and we're trading in the bull market. You know, I'm gonna know this for the next couple of months. All right, so that's important. There's some other bullet points I put. In terms of what do we offer, stock forecast toolbox. It's a great model. If people ask me, can I use it for day trading? Can I use it for longer term trading? The answer is yes. It shows you the model that the market is resilient and bullish. It shows you that the 390 you want to probably buy, and the 397 you probably want to sell, right? In the next 10 days, you know, going into the, you know, earnings season, best case we reach 411, right? Worst case, you know, we stay at 390. That's what the model says. I don't agree with this model completely because I think, you know, with this issue with Deutsche Bank, if there's some kind of news that these issues are getting worse, then we could have, you know, Russell 2000 is breaking down, 2-year yield is breaking down. So we could have like over-exaggerated reaction where we can reach 380, 375. Model doesn't look at the correlations between different asset classes, right? It's not a multi-factor model. It just looks at the price action of spiders. Just spiders alone, 390 is your support. So we offer stock forecast toolbox. We'd also offer picks, active trader, weekly trader, monthly trader, where every day you're going to have a list of bullish, bearish stocks, right? Today, you know, Microsoft, right? Obviously, mega cap technology stocks is the place where everybody's hiding, right? So, okay, so you buy Microsoft. It gives you entry point, suggested exit points, and different strategies, right? If you see pre-market futures are down and, you know, Deutsche Bank is falling apart, well, you probably don't want to enter it, you know, at 277, right? Maybe at 276, right? At this point, it's the same. Sometimes it's different, right? It's just previous close or predicted low. At this point, they're the same. But that's the trade ideas. But you have to trade. You have to decide which of these trades you're gonna make. And you know, I encourage you not to take all the signals because that's just too many signals. You just have to, based on your trading style, you can do monthly, weekly, or active. If you want to know what I'm trading, then I propose elite trading, right? Elite trading. We have morning bell, closing bell. We show recordings, and you can enter your phone or look on the web and just see all my trades, right? This is all available to you, right? So I sold, what did I sell yesterday? I did these short trades, right? Half of the options volume are weekly and 0 days till expiration options. So I gave an example yesterday when the spiders were at 390, I said most likely they will hold, right? So I sold 3 or 4 put. Market actually reversed very quickly. So I decided, okay, I'm gonna close it for 50 cents, right? I mean, this is literally 18 minutes difference. So sometimes I do these short-term trades, whether it's earnings or whether it's QQQ or Tesla, that's the idea, right? When you see support, you sell out of the money put spread. When you see overhead resistance, you sell out of the money call spread, especially when volatility jumps, right, from 20 to 24. Yeah. So those are the type of trades you can expect in Elite Circle. Some of them are options, some of them are stock, right? Sometimes people say, Vlad, well, you only trade in options. I only trade stock. Yeah, I do trade a lot of options, but I also trade stock, right? Look, ETFs, so SLV, NOC. So you can find my trades in SLV and NOC. Any questions? Right, fast forward a few months, you did not project the ultimate growth to her. She's on the global. Doug, I mean, I know you're bullish on oil. Again, the only way you can be bullish on oil because of these reports that you're referencing, if you think we're going to be in a soft landing, right? If we can avoid the recession, because by definition, if we cannot avoid the recession, oil is going to continue to drop, right? And there's a big disconnect between China reopening and crude oil every week making new lows, sitting at the key support prior to the war in Ukraine, November lows, right? So if it doesn't hold these levels, well, you can actually see there's not much support, right? It's kind of in free fall, right? We already familiar pattern across all the value stocks or small cap stocks is this pre-pandemic support, right? This is when the pandemic started, right? When everybody realized we have this unknown virus and the market just fell apart. We are back at that level, right? We're back at that level, right? 3 years later, nothing has changed. Small cap, banks, value stocks, everything but technology are at these levels. This is the last man standing, right? There's not much support. If you believe in soft landing, I agree with you, then the oil is going this way, right? This is, you think we're in the bull market, China is reopening, and you know, they're gonna sign a peace agreement with Ukraine, and life is good, right? So yes, then you buy oil. If you think there are geopolitical risk and credit issues and we are entering recession, then the answer is no. I mean, yes, maybe we'll go to 80, but then, you know, this is not the bottom, right? Then we're going to 2. So, you know, I'm obviously in the bear camp. So, you know, and that's the disconnect too, right? There are a lot of people that say, oh, we're going into, you know, we're in the bear market and we're in recession, but oil is going to 100 because of China. I mean, that doesn't make sense to me, right? You know, China is not going anywhere if there's a recession in the United States and in Europe, right? There's only so much oil they can buy from Russia, and Russia can buy semiconductors from China. At some point, people are diversifying away from China. They have serious financial issues and distress in their, you know, debt and, you know, housing, right? Where there, you know, cities, unoccupied cities, So China had a lot of problems, right? If we can avoid soft recession, then yes. I mean, and we've signed a peace agreement between Russia and Ukraine, then one is possible. I'm not saying this is out of realm of possibilities. It's not. It's possible, but if I have to guess, I would say 20%. In my mind, there's a 20% confidence that we're just going to go to 100, right? Like Goldman Sachs said. And this is not just Doug decided. I mean, a lot of research firms actually calling out for 100, right? Or at least they did before, prior to 2 weeks. A lot less now, but still, a lot of people think we're going to 100. Very popular call. So you don't want to dismiss it. You want to be flexible and kind of see, But since I think there's a high probability of recession, then oil will not be at 100. It's probably not even going to be at 90. Could it be at 80? Sure. 85, fine. But that's it. Thank you, Doug. Kevin, Schwab looks good. I like Schwab. I obviously work for Options Express, Schwab. I mean, this is a good price, right? 45, again, this magic number, right? You can see top to bottom approach does work, right? So Schwab is back to pre-pandemic level. Again, same rationale. Is this the bottom? I would probably say no, right? So, but is this close to the bottom? Maybe we're not going to reach this level, right? Maybe, probably not, right? I doubt. Well, you could, but I would be surprised. But yeah, you can start buying here and then buy here, and if I'm really get surprised, then buy here. So dollar cost average, because you just don't know. Right? You think we're at the bottom, but there's no signs of bottoming process, right? Well, we didn't make new lows this week. If in the next 2 weeks we're not making new lows, I would say that this is still not the bottom, but we're probably close, right? Maybe another break to 35, and then we do this, right? So I think that's my core scenario, right? My core scenario, not the bottom, maybe 35, 40. Nobody knows for sure. So maybe it's time to start thinking, after stock is down 50%, maybe that's exaggerated reaction. Even though there was an article in Wall Street Journal, and I know he came out and said that, don't worry, we have plenty of liquidity, but they're very heavily invested in the bond market and, mortgage-backed securities. So you just don't know what they're going to say during earnings call, right? If Schwab come out and say, listen, we have billions of dollars in these securities, and we're going to write off 30% of them, write down, because that's what everybody's going to do, well, then this is not at the bottom, right? This is not the bottom. Thank you, Kevin. When do you see bear market becoming more consistent? Well, I think if we break below this level, to me, this is the line in the sand, right? Because if we break through this level, that it probably negates soft landing, right? A lot of soft landing will say, no, Vlad, you're wrong. I think this is the line, but again, I don't think this will hold if we break this level. So to answer you, bear market more consistent. Right now, it's inconsistent, right? It's like 50% retracement from October lows to year-to-date highs. So with 50% retracement, not consistent. This is bulls are in control right now. By definition, bulls are in control right now. If we drop this below December lows, then this would be first punch to bears, right? If we break through this level, and then the second punch will be this, right? And this is just going to be a matter of time, right? Okay, maybe it's April, maybe it's June, maybe it's July, maybe it's September. I don't know, but it is coming, right? It's coming. And the answer to that question is earnings, right? There is uncertainty about earnings, right? I had the same discussion in December. I said we will break the bottom by April, and I was completely wrong, right? Market went the other way. It looks like a similar setup, right? So timing is a difficult business, right? That's difficult because it just depends on the news, right? And you think earnings will be affected, but they might not. right? This financial issue started only 2 weeks ago. I mean, so March will be reflected, right? Third of the earnings will be reflected. Not third, but it started March 15th, so a little bit before that. Okay, 3 weeks. I mean, still not even 30%, maybe 20% of the earnings of S&P 500 companies are going to be reflected after these issues start. So, I mean, we just have to listen to these earnings calls and see what happens. Right, but you know, it's still every day kind of, nobody talks about this, but you know, I was watching, it's Accenture. They're letting go 20,000 people, right? These are, you know, high-paid jobs, right? Consulting, you know, Accenture usually doesn't let go 20,000 employees. How many total employees do they have? That's a better question. Accenture. So what is this? 3% of the workforce? 3% of the workforce? I mean, it's a lot, right? It's a lot. 3% of the workforce. You know, it's not the end of the world, but it's, you know, probably, you know, the business is being impacted if you're letting go 3%, and that's the first wave, right? There could be multiple waves. And Joseph, how does NOC look? NOC looks, it looks like, well, there's two ways it can go, right? Double bottom, right? Classical double bottom, right? Head and shoulders. Or classical ABC pattern, right? I don't know, right? Only time will tell. I don't know. Russia and you know, Moscow and Ukraine and China has not reached any peace agreement, right? China is pushing Ukraine to basically go back to the table and reach a peace agreement, but you know, Russia is not going to withdraw their forces from, you know, 30% of Ukraine, right? It's a no-starter, you know. In my mind, you know, nothing's going to happen, right? And I think DeSantis actually came out yesterday and said, since China is helping Russia and providing more, you know, more liquidity, providing, you know, buying gas, buying oil, you know, so not supplying weapons, but anything outside of the weapons, China is doubling down, right, and improving the relationship. So DeSantis came out and say, listen, I'm changing my point of view. You know, we want to help. You know, Republicans want to help Ukraine, not only Democrats, but also Republicans. To me, that's escalation, right? That's escalation. There is a major offensive that's going to start in the next months or so. If there is an easy victory, which is completely possible, where Ukraine is just going to free up all of its territories, then you're going to have this, right? So this is kind of end of the war on the battlefield, not because China wants to, but you know, end of the war, right? So if there's end of the war, then it's this price pattern. If there's no sight into the end of the war, then it's this price pattern. I'm hoping that it's this, right? I want this to happen. And, you know, I'm willing to lose some money on NOC. We made enough money in the past year that, you know, that's okay. But, you know, emotions and biases aside, I think that probability is low. Thank you, Joseph. OPEC has a meeting next week. Thank you, Kevin. OPEC. Okay. I mean, OPEC obviously has, you know, they're going to decrease the production. They don't like oil at 65. You know, short term, it's going to go up, right? If they decided. But my understanding, they're not planning to. $60 for WTI is still a pretty good price. Look in the lower left corner of the chart page, oil prices to remain low. You talking about this? I agree. I think oil, it's a pattern of lower highs and lower lows, right? And I know Goldman Sachs thinks it's 100 to 110. That's because they're in a soft landing camp, right? And I think they actually changed their opinion, right? I think they pivoted and say they're now in hard landing and probability of recession has increased. So they're gonna, you know, at some point they'll revise their price target for oil down. Lower right corner. Or Forward curve. Okay. Yeah, that doesn't look good. Okay. Yeah, we'll see. Thank you, Bill. Thank you, Doug. Irene, how there are hundreds of companies on earnings. How do you pick each of them? Usually I look at liquidity and probability. I look at implied volatility. So there's a formula that I go over and I look at the implied volatility. If the implied volatility of the move is less than 10 to 15%, and options they have weekly options and tight bid and ask spread, then I trade those names, right? So like Microsoft, Caterpillar maybe not, but Microsoft, Nike, those very well covered names like JP Morgan, right? Bank of America, Delta Airlines. So stocks that have ample of volume, tightened bid and ask spread, well covered, and implied volatility matches historical volatility or better, right? And I get at least 30 basis points return. So there's few criteria that I go through to pick those stocks. Yes, price is important. Production is also a factor, Doug. I agree, production is a factor, but the biggest factor is the demand, right? You can manipulate production as much as you want, but if there's a demand destruction, then that's an issue, right? Irrelevant of the supply, right? Supply and demand, I understand, but at this point, I think the unknown is the demand. Supply, yes, OPEC can control the supply. They cannot control the demand, right? They cannot. All right. Thank you, Irene. Doug, thank you. All right. Any other questions? All right, it's 10:30. Let's see, how's the market doing? So 2-year yield is off its lows, right? That's a big win for the bulls. I thought market is going to collapse since we broke through these lows. It didn't, right? So it's a win for the bulls, but again, very precarious situation, right? It's the pattern of these lows, and then I would watch 4%, right? That's kind of the line in the sand, right? As long as we are below this level, that means market can retest December lows at any given point, literally, Monday or Tuesday. So yield has to jump back up, right? We have to see something like this, right? Break above this level. Then I think, March, April, May could be stable. But the longer we stay below this line, the higher the probability that the rebound is going to be very limited and we are going to retest the December lows. Dollar is also high, right? We have a pretty big jump in dollar. And let's see, semis kind of too far, too quick. They're leading the market to the downside. They were leading the market to the upside. And actually QQQ start underperforming the spiders. So I would watch that. I mean, Russell 2000, right? It broke through the lows, so that's a problem. And I would watch KRE. I mean, KRE is actually positive, so that's a good sign for the bulls that this pullback is probably limited, right? If KRE was down 6%, I would be worried, but since KRE is turning positive, that's also how the banks, XLF. And banks are XLF. Banks are still weak, so that's not good. XLF is still weak, making new lows, so that's a problem. Right, I think JP Morgan kind of was making new lows, right? So it's a fight between bulls and bears, kind of a main line. All right, that's all I have for today. Thank you very much. So next week there's no strategy roundtable, and the closing bell is only on Wednesday. Morning bell every day will be morning bell. I'll be traveling, but we will cover. All right, thank you. Unfortunately, to Ukraine, Biden needs destruction, corruption. All right. Thank you, Kevin, for your view. Okay, thank you. Can I recommend an income ETF based on dividends? Well, VTV, like I usually in 401k, if I want dividend type, 2.7. I mean, pays you less than money market funds, so that's the question. But 2.7. Let's say dividend paying ETFs, dividend based. Yes, let's see. I know Wisdom Tree had good one, top monthly. Not let's see, dividend growth. Let's see, can you do exit under management cream? Let's see, I sure. Yeah, let's see value. And then also 3 ways to be best. Without taking too much risk, I would stick with VTV or spiders, right? It pays you 2.7. Value stocks, sold off significantly, right? Where I think, let's see, where I think the risk is, I mean, still a lot, it's not, still kind of far away from the pre-pandemic lows or just October lows, but I would say that's probably the safest. And that's where I have like Vanguard value stocks ETF, VTV. Then inflation. Kevin, yeah, Fed has difficult position. All right, Kevin, thank you. Ricardo, thank you. All right, guys, you've been the best. Thank you very much. See you at the closing bell, and I'll see you in a week. Thank you.